Okay, Mohammad Barkeshli, welcome to the show.
Thank you for having me. Long-time listener, first-time caller, as they say.
Well, thanks for coming. And it's funny. Obviously, we've done hundreds of episodes on this pod, but the bulk of them have been, super wide range. But what we haven't done a lot of is LPs that are allocating capital to climate. And part of that is because LPs in general, it's kind of a black box. A lot of them aren't out there much talking about their work. And Hall Capital is a good example of a really important firm in the space that most of our listeners have probably never heard of. So I'm really grateful that you're making the time to come on. Personally, I have a ton of questions and a lot to learn. And I think there's a lot of others that are in my shoes as well. So you're doing us a great service, and hopefully we can do you a service and enable more people to get to know the great work that you're doing as well.
Great. I agree. I think more transparency from the LP community helps everyone downstream. So that's the idea.
Before we jump in, why don't you think more LPs are out talking publicly about what they do? And then conversely, why did you say yes to coming on this show?
So I don't know if I can speak for the whole LP community. I think, from our seat as an outsourced chief investment office, our business is one that's really bought and not sold. You can't really sell people on the idea of a diversified multi-asset class portfolio if they don't want it. So we're not trying to, there's typically few marketing benefits to talking publicly. We're pretty engaged and involved with other LPs in our own community. And that's where we see most of our impact. When we're talking about climate-related strategies or investment opportunities, it just hasn't been something where, being public-facing has been necessary. But I think, in this sort of emerging space, as I mentioned, having more transparency about how LPs think and evaluate investment strategies and look at the underlying businesses that those strategies hold and invest in is probably just helpful for everybody. This is an ecosystem that's, collaborative. And so part of the reason I said yes here was obviously really respect the work you all are doing on this journey, but also wanted to shed some light on some of our thinking for this community at large.
Awesome. Well, I'm glad you did. So for starters, maybe just talk a bit about Hall Capital, the firm, what you do, and of course your role within the firm as well, just so that we get some context to listeners.
Sure. So we're a $40 billion outsourced chief investment office for high net worth families and some endowments and foundations. Katie Hall started this firm almost 30 years ago now with the backing of a handful of prominent San Francisco families. But it's now grown to over 130 clients. And we're kind of known for our customized investment strategies and innovative solutions that are, that we design to help clients achieve financial goals. We don't have a one-size-fits-all allocation or model portfolio, but we build customized multi-asset class portfolios for each of our clients or each pool of capital within each client relationship. So it's really a comprehensive relationship that we have with our clients. We provide a range of advisory services, financial planning, tax planning, estate planning. But we don't really do any direct investing. We're typically investing our clients' capital across funds as limited partners. So for me, it's a really great window seat into the investment management universe where, we evaluate, we select, and ultimately allocate to managers with various strategies across, fixed income, public equities, hedge funds, private credit, as well as private equity, venture, real estate, really, you name it. We look at it and we allocate to it. So, going back almost, I think exactly 10 years ago when sort of a next leg of impact investing was taking hold. And there was a lot of discussion about impact investing, if you recall, socially responsible investing, philanthropic investing, divestment campaigns, et cetera. We at Hall had I was an analyst back then, but we had a lot of frustration with the way people were using these terms because these things sort of meant very different things to different people. And I remember being in meetings with either a client or investment manager where, you mentioned the word impact investing and sort of you get a question of, oh, since when are you not interested in making money? So we had a lot of frustration with that, and we ended up devising our own terminology and methodology, which we call full consequence investing. Not that the world needs sort of more jargon in this space, but it was a way for us to talk about, the effort to capture what people were trying to do or what the goals of ESG investing was, which was to really incorporate much more sort of explicitly and holistically other factors into investment decision-making processes. And we wanted to, talk about that. And what we were saying by full consequence investing, which internally we call FCI for short, was that if investors are really taking into account all of the consequences of a given investment, thinking deeply about sustainable use of capital, human capital, financial capital, physical capital, then you actually reach, quote unquote, the right answer from the ESG perspective, regardless of what you call it. So, we have a spectrum as we look at a multi-asset class portfolio of investors that, where ESG factors or FCI factors are central to sort of their investment thesis and what they're doing, and where, it's one of many factors more from a risk mitigation perspective. So that's what I focus full time on. And in terms of, the what that translates to, it's investment opportunities across asset classes that have to do with climate change, that have to do with education access, healthcare, and financial inclusion, affordable housing, sort of all of the social and environmental challenges that are longer term.
Got it. And when it comes to your client base, is there a minimum threshold of assets that it makes sense to work with a firm like Hall Capital? Because I tend to ask questions in twos for whatever reason. And this is probably just more of a general portfolio construction question, but at what size of assets does it make sense to go beyond the basics of just like stocks and bonds? So alternative assets, for example, is there a threshold below which you should have zero alternative assets unless it's a hobby versus an investment?
Yeah, those two questions are probably more interrelated than they sound. And the second one is hard to answer in terms of the size of our clients. For our business to make sense, and this relates to your second question, for us to be able to build a truly diversified multi-asset class portfolio, the size of sort of capital should probably be above 100 million. So, if you look at, we have about 130 clients across, $40 billion, that gets you a sense for the average size of that client. Obviously, we have some that are way larger and some that are maybe a little smaller than that average. But it relates to your second question in terms of where can you actually build a truly diversified portfolio. And we think that's, at that level. And oh, by the way, in different pools within our client relationships, if this is a grandchildren's trust, you might not have the size of assets to do alternatives, and that's okay. I would say a factor that goes into whether alternatives or, private allocation, for example, is prudent for a given portfolio has to do with how much a client or an individual within a client relationship needs in sort of life expenses over a foreseeable future. And that usually dictates a cash and fixed income allocation. And that's usually a dollar amount, not sort of a percentage. And that is a constraint around which we have to work, right? If we have X amount in cash and fixed income, how much liquidity trade-offs can we afford in this portfolio? How much do we want to go sort of beyond that in alternative asset classes?
And given that the alternative asset landscape is, well, maybe it's even broader than alternative asset, there's so many different funky places to put capital. There's like...
That's what makes my job interesting.
Project, I won't even know all the, even a little sliver of all the different places. If you look at the landscape of investment firms, do people generally have the same buckets for the same asset sizes, or does it vary greatly across firms, and what are the key buckets for Hall? And I guess the asterisk is you already said that everything's custom, but is it really custom? Like, is it custom within the same typical buckets, or is it really custom where it's like all over the map?
I don't think it's all over the map. The typical buckets that we're allocating to in terms of asset classes are fixed income, public equities, hedge funds, which could be, credit oriented or credit and equity, as well as private credit, which sometimes we call hybrid, as well as private equity, venture capital, private real estate, and, things on the margin that might sort of be crossovers between these asset classes. Within each asset class, we tend to be quite concentrated in terms of the set of relationships with investment managers that we have. And so we're not keen on, diligencing and approving an investment strategy that then ends up going in sort of one small pool within our AUM. That's just not a good use of anyone's time and resources. And so maybe this is getting to your second question, but we tend to think about those asset classes and then think about the set of investment manager relationships that comprise our options within those asset classes. And then where it's really customized is the allocation of a client to each of those asset classes or among the option set of investment managers within each asset class.
So I think what I'm hearing from you is that you take the diligence part of that process very seriously. And so to put the Hall Capital stamp on it, or whatever the internal lingo that you use, is a big deal and really means something. And since it takes a lot of work to do it, you don't want to do it unless you can put real capital to work across your client base. And then for each client, if they have their own relationship or their own fund or whatever, their brother-in-law started something, then maybe there's exceptions that maybe don't go through your process. But if it goes through your process, you want to utilize it broadly, and then it's the allocation that changes more than the fund, unless it's an extenuating circumstance that I just mentioned, like there's some relationship or other reason why it doesn't make sense for that client. Is that right?
That's correct. Our investment research function, which sort of looks at the universe of investment managers and evaluates them, does diligence, and selects who we want to partner with, that's pretty centralized. Where you get a lot of customization, as you say, is in the allocations to those managers across the different asset class buckets. And, we start with a place of we don't have to be everywhere or do anything. So it's really a matter of when we're looking at an opportunity, really thinking through the investment opportunity set, what is driving it, and then thinking about whether, we think that opportunity set is something that's available sustainably over time, or if it's, more of a trade for this year and next year. And then thinking through the people, the players involved, who's doing it well, what's the evidence of success that they're doing it well. These are investment practices, investment discipline, track record, history, all of the good stuff that you've heard about. But it's also about understanding the organization, right? So what makes an organization tick? How are people compensated? And that's really part of our judgment of the probability that a team might be successful executing on an investment opportunity. And we source these things sort of everywhere and any way we can. We cast a pretty wide net, but we're also, we have a reputation now going back 30 years. So we're pretty well known at this point, and we get a lot of inbound. I don't know if I have the numbers for this last year, but for the year before, I think we received close to sort of 1,000 sets of new materials from new funds, excluding our existing relationships. So we get to really look at everything. And then to your point, look at who we want to partner with, where do we want to make an incremental investment, and then our portfolio managers for a given client decide where they want to allocate from a given balance sheet.
Now, you said that investment research function is centralized. You also said that that there's all these different types of vehicles, from real estate to hedge funds to PE and venture capital and public equities, and I probably missed some. So are the members of that investment research team generalists that can evaluate all of these asset classes, or do you have specific people assigned to specific asset classes that are experts in those areas? And since I ask questions in twos, I'm going to ask you the same thing about the full consequence side and your work and how that interrelates.
So we have I think a 20% investment research team. We divide that team group across different asset class teams. So exactly to your point, we have a public equities team, a private equity and venture team, a real estate and real assets team, and what we call sort of an absolute return and credit team, which covers fixed income to private credit to hedge funds. And then we have two smaller teams that are cross asset class and multidisciplinary. One is a group that does a lot of our macro work. So, there's a oil price shock, there's a war in Ukraine. That's not a private equity issue, that's not a public equities issue, but it has implications for all of the above. So you need sort of a cross-disciplinary group to look at that and try to translate that. And the other one is full consequence investing. That's my team. So we are cross-asset class, multidisciplinary. And the idea behind that is not to say that, all of this ESG work or climate-related work should be siloed in this one corner and they take care of it and everyone else does business as usual. No, everyone in each asset class team is fluent in some of our diligence in full consequence investing, but we think there's value in having someone who's sort of bilingual in both sort of financial investment diligence as well as impact and ESG diligence, who can help teams compare opportunities across asset classes and compare best practices when you're looking at a climate-related private equity strategy versus a climate-related, private credit strategy. You want to be able to translate some of those learnings across asset classes. And that's what, I help with and what our team helps with.
Now, this macro work and the FCI team, see, I already know the internal hall lingo, but these teams, are they people that come out of the asset classes, or what backgrounds would one want for the macro team and for the FCI team? And to be honest, I don't even have a guess. I'm really curious the answer.
Yeah, no, it's a good question, and different organizations do it differently. We are pretty committed to having this be integrated across all of our investment process. So the idea that there would be a silo here doesn't sit well with us. So the head of our macro team, which we call cross asset research, is also the co-head of our public equities team. So there's synergies between those, and you can imagine why that might make sense given the sort of liquidity and daily nature of both efforts. Lizzie Fisher-Marshall, who heads up my team, is also the co-head of private equity and venture. And that is historically because, a lot of the sort of reps we get in terms of looking at opportunities that have to do with social or environmental opportunity sets come from early stage venture or private equity. That's because those asset classes tend to have longer time horizons, which match the time horizons of these social and environmental challenges. They tend to have more control over the businesses that they invest in, with a more partnership approach that's inherently engagement focused. And so it just made sense to have that overlap. I worked in different parts of the organizations. At Hull, I was actually part of the portfolio management group early on when I started, then switched over to our investment research. I worked on that macro team, the first iteration of it, and so got to know different asset classes throughout that. And then when I went off to get my MBA at Stanford and did some direct investing work, I worked on, in private credit myself at community investment management with a focus on financial inclusion and impact. And I worked on private infrastructure investing with, mostly looking at transportation and water infrastructure. And I worked at a sovereign wealth fund looking at sustainability related businesses. So I thought, I think having the right combination of people working on this that doesn't become this silo, we're only fluent in ESG speak and don't really speak other investment related topics, could be harmful. And we're trying to avoid that.
Now, when you think about your existing client base and directionally where you aspire to go as a firm, and you also think about how you want prospective clients to think about you and Hall, where does, I don't know whether to use the word impact or the proprietary impact word, but the I'll say FCI. Where does that fit into the Hall Capital story and brand?
It's definitely we view it as part of our secret sauce. And, everything we do, every investment that we approve has to have at least a table stakes amount of ESG integration. This is in line with our philosophy, why we came up with the sort of terminology of full consequence investing. The idea is that if you're a long-term fundamental investor, let's say you're investing in, industrials businesses in Europe, you're invested in a cement plant or a steel plant, and you're not thinking about the risks coming from decarbonization and energy transition and the technology that's sort of revolutionizing that space, you're probably just not a good investor, right? You can do that at least from a risk mitigation perspective. And, you can also use that as a lens to identify opportunities. The parallel I sometimes draw is with, the moniker technology investing, right? Every investment job is also a technology investment job. If you're invested in any business and you're not thinking about at least the risks arising from competing technologies, you're just not doing your job that well. But you can also be a technology expert in the same way that you can be an environmental climate expert and say, hey, I have some views about where this decarbonization trend is going. I have some views about the shape of the energy transition over the coming decades. And I can invest behind that, not just from a risk mitigation perspective, but as a way and as a lens to identify compelling opportunities. So in my end state, and as I think about Hall in the future, FCI is not something that you would even have to name. It just becomes part of good long-term fundamental investing. And I think that's always been our philosophy. I think as there is wealth transition coming up over the next decades, as a younger generation of asset owners come into their own and focus more on some of these risks as well as opportunities, this is going to become only more relevant, despite the emerging culture wars around it. But I think we view it as sort of fully integrated in how we invest and how a long-term investor should view their portfolio.
You mentioned that within full consequence, there are some different impact lanes. When you look at this portfolio of, what did you say, 130
clients,
does FCI get involved in every one of them? So every one of them. So
if I find a compelling private infrastructure opportunity that's looking at, infrastructure transactions that are related to the energy transition and decarbonization, I underwrite that as an investment opportunity. I kick the tires on making sure they're thoughtful on impact, thoughtful on climate assessment, environmental impact assessment, all of that. And it might be, what we call FCI central, as in, the FCI factors are central to the management team's investment thesis. I underwrite that as an investment that is compelling on its own. And so we would allocate to that opportunity across all of our clients, regardless of whether they have a climate passion or not. And so, sizing might differ depending on that passion, back to the point of where customization matters. But it's rare where we, make an investment that would be very relevant to our full consequence investing work, but only allocate to it from a subset of our clients. there is definitely degrees. I want to be transparent about that, especially when you get to other, maybe climate is not a great example because it really is pervasive across every aspect of life. But when you look at, education, for example, investments in education or affordable housing, that might be sized differently or go in certain portfolios where the asset owner has a more explicit focus on that type of work and opportunity.
So should I think of FCI as a category of products that you could offer to clients, or is it a key diligence box, if you will, for any product that is offered to Hall Capital clients, or is it both or either?
It's definitely a key diligence effort across all of our diligence efforts, and it's one where we've identified that it would be helpful to have dedicated resources because it overlaps with so many other things that aren't necessarily in the core toolkit of a financial diligence effort. And so, we don't think about it as a separate product category. We don't really think about our work as products even. We're partners with our clients to try to solve their financial goals. And we think this is a key aspect of being and executing a successful investment strategy.
And if I wanted to double click on FCI and try to immerse myself and listeners in what it means to be FCI and the lens through which Hall Capital evaluates these investments from an FCI standpoint, can you take a stab at that? Just explaining what falls within FCI and how you evaluate these opportunities across categories?
Yes. So as I mentioned, there's a spectrum when we think about these topics, right? There are investment strategies where, let's say, climate considerations and climate risk is one of many factors considered during the risk diligence of a given investment. And so let's say you're a private equity shop focused on financials, right? And you invest in businesses that sell to banks or are, related to the credit landscape and lending landscape, or you invest in insurance businesses. We make sure that your investment process as that investment team incorporates a thoughtful level of, call it ESG diligence, understanding what are the best practices when you look at a debt collecting business. How do you make sure that you're not running into some externality risk? You're not running into some regulatory risk. You're not running into governance risks. How do you make sure that if you're invested in a bank, that bank is not in an outsized way financing emissions and might run into risks that arise from either regulatory or changing landscapes or the stranded assets of those businesses that are being financed, right? That's risk mitigation. And we help ask those questions and conduct that diligence. That's one end of the spectrum. And not that it's binary, it's really a continuum, but other end of the spectrum is, I invest in fintech businesses. Let's say, keep with the financials, right? There's maybe a venture capital team that invests in fintech businesses that are really designed to serve underserved low-income communities or provide financial access to small businesses that are otherwise ill-served by traditional banks. Or back to climate, I, am a venture capital group that invests in innovative carbon capture technologies, right? That's really my mandate. I look at mitigation, adaptation, and removal, if it's a broader mandate. But that's not risk mitigation, that's identification of investment opportunities through that lens that has to do with the same underlying sort of toolkit, which relates to FCI. So double clicking on FCI to your question, it's really making sure that all of our investment managers, regardless of their mandates and investment strategies, are incorporating a thoughtful level of risk mitigation when it comes to climate considerations or social challenges, labor issues, regulatory risk, all of the above. But on the other end of the spectrum, managers that are really pursuing explicit impact, be it in the form of emissions reductions or in the form of better outcomes for healthcare and education, while at the same time pursuing financial returns.
I'm curious about the decision to go with this kind of branded definition of impact. Does that imply that there are some distinct differences between the Hall Capital FCI approach and, say, traditional ESG?
Well, one is under our control and we can define what we're talking about. And one is subject to sort of the ether, right? And we ran into that 10 years ago, and I think we're running into it again now with the, whatever you call it, ESG backlash, which, by the way, I think, is to an extent healthy, right? But we wanted to be able to really name what the effort was and what people were trying to do when we're talking about ESG investing, which is, again, to incorporate much more explicitly and holistically these other factors, externalities, and social and environmental challenges into the investment decision-making process. And the ESG debate, call it FCI, call it ESG, call it, responsible investing, whatever you call it, is sort of intractable in the abstract, Jason, right? I've never been able to convince someone of the merits of ESG and FCI by just looking at a meta-analysis of performance over time for different strategies that identify themselves as one versus the other. But it's really quite clear when you're looking at the investment decision level, right? If you're a car company today and you're looking at sort of where does my market share growth come from, right? Like EVs are an obvious investment decision. That's not an ESG decision. And I don't care if it's an ESG decision or not. It's just sort of a reality of that business decision. If you're, that's true across industrials, it's true across consumer businesses. If you're looking at supply chains and transparency there and the shifting sort of preferences of consumers around all this, it's true in everything that touches climate, right? These are not necessarily, from an economic perspective, good or bad decisions. They're just decisions that make sense. And when you have a holistic view, an explicit view around incorporating these factors into your decision-making, it just kind of becomes obvious in the specific instance. And that's what we're trying to find and kick the tires on.
And given that climate in particular is a bit unique in that it's not really a vertical, it's an area of expertise, but it stretches across every vertical. And so given that, if a client were to come to you and say, for example, I mean, maybe 5 years ago, how I was feeling before I started on my climate journey, or now MCJ for short, similar to FCI, right? So I was feeling like, man, there's this like drumbeat of bad news and the scientific community is foaming at the mouth and no one's listening, but I don't really understand the nature of the problem. I don't really understand the best ways to address it. I don't really understand what I can do to help. So if a client were to come to you and say, look, I want to invest with more of this lens in mind, but I don't understand it and I don't come in with specific opinions or knowledge, what guidance do you provide, and how much of a point of view does Hall take, given the amount of debate that occurs even from reasoned, well-reasoned experts on all sides of an issue?
Yeah, let me think through how I could answer that in a specific. Let's say we want to invest around the theme of energy transition, right? Which touches climate-related investing across asset classes, right? We first look at, okay, how do we produce energy? How do we transmit energy? How do we meet our end users? Where is that energy demand coming from and what's the composition of it? And then what are the emissions that come out of those end uses, right? And so if you have a view, for example, as you mentioned, you're a client, you come in and you say, I want to make sure my investments are geared towards reducing emissions. It's one thing to say, hey, come, invest in this one fund that is doing decarbonization technology at the very early stage. It's another thing to look systemically and say, you have public equity exposure to energy producers or energy transmission businesses. Let's make sure those investors that you're invested with have an engagement focus such that they're engaging the oil and gas producer to make sure they have some path towards transition. Let's make sure if you're invested in real estate that, that's an end use, right? And it has a lot of emissions. Let's make sure your private real estate managers are making sure that their buildings are upgrading up to the best standards for emissions reductions. And that's, by the way, carbon emissions as well as waste, as well as water use, et cetera. Let's make sure that, if you're invested in manufacturing businesses in other parts of your portfolio, that those investors are doing it with a thoughtful lens towards the risks that arise from decarbonization and from the technology boom happening in alternative ways of manufacturing things. And so it's really a holistic view. Our client portfolios reflect in a lot of ways the broader economy. We don't take sort of I might have mentioned this before, but we don't take like a divestment approach. Let's say, let's clean up your portfolio, make sure it doesn't have any emissions. You're not invested in any energy or any real estate that emits anything. But the real world out there, the economy at large hasn't changed, right? You just washed your hands in your portfolio. That's a legitimate approach, and I'm not against that. But I think a better approach, and one we're trying to do, is really tackle that systemically across your portfolio. So you might own, ExxonMobil, right? But you want to make sure you're engaging at the right activist level with the board of ExxonMobil so that they can come up with a transition path. People can argue, and our managers can have different views about the validity of those paths and those plans. But we think that engagement, that stewardship, is part of the answer if you're trying to build a portfolio that's geared towards climate change. Does that help answer that question?
It does, and it's not an easy question to answer since there's so much nuance, and also it's like, well, it depends if you're looking at this area or that area or this type or that or this type of family or that type.
Well, the good news, Jason, is when we started doing this work 10 years ago, or even going back 5 or 6 years ago, if you wanted to build a multi-asset class portfolio that had a climate theme, it was really difficult. The available options that were compelling were mostly in early stage venture and technology. And then some, maybe public equities that were not necessarily having impact in terms of real world outcomes, but they owned, let's say, renewables businesses versus fossil fuel businesses. But today, you have a lot more options across asset classes. There have been a lot of interesting investment groups, investment talent that have come together to tackle climate-related opportunities across asset classes. So you have, private credit strategies that are scaling out. You mentioned project finance early on, that are scaling out, residential solar, and we have exposure to that. There are infrastructure investments that are very much related to this theme. There's public equities, as I mentioned, public equity strategies that have a real engagement focus, other than just sort of owning the right things. But let's own things and engage with them to improve them. There are opportunities across real estate, across really, you name it, all of our asset class buckets, where you can have a credible and compelling portfolio that's really geared towards climate change and doesn't have, in our view at least, sort of return trade-offs, but is well set up to take advantage of this humongous theme that we have over the next decades called decarbonization.
Now, there are some types of investment. So I'll share a bit of what I've observed, but I want to make sure before I ask you a question associated with it that we calibrate and have observed the same thing. That there's some types of investments that are important from an impact standpoint, but look, like if you're just looking to make money, like there's better places to put that capital. And then there's some that it's like, oh, that's going to print money, but like, is it really doing good for the world? And then there's this, this kind of middle ground where you can, find things that do good for the world while also not compromising on returns for that asset class. First of all, do you agree with
yes.
with what I just said?
Yeah.
Okay. Yeah. So you do. So the question is, does FCI only comprise that middle bucket, or are there times where you would either recommend an investment as Hall Capital that that maybe doesn't encompass FCI but is going to generate attractive returns, or the other way that might be more, and again, I'll throw out some buzzwords here, but be more catalytic or concessionary in nature, where it's driving impact explicitly, maybe even at the expense of returns?
Those are three great different questions. So let me take them.
Sorry.
take them all the way. I think most of my
You can tell I have some, I don't know if it's ADHD or like some undiagnosed something.
No.
Here.
You're
like imagine me sitting down to like read a book cover to cover.
I suffer from the same thing. But I think the bulk of our work in full consequence investing is focused on the overlap that you mentioned, right? Where things are, and it's actually harder to find than you realize. A lot of people say that there is overlap in their strategy, and you kind of dig in and you understand that maybe not. And so the bulk of the work is identifying and building conviction around strategies that are really taking advantage of a financial opportunity set while also pursuing social or environmental impact. To the other points, maybe I'll get to the concessionary piece last. To the point of, where there's a strategy that has a lot of return potential, but doesn't necessarily have impact, or impact is sort of not applicable to the strategy. We obviously do a lot of that in our portfolios. The key thing is making sure that, at least from a risk mitigation perspective, those teams have the right processes in place to incorporate that lens into their risk management, right? And sometimes when you think about that and you talk to the team and they're like, oh, this is a great financial opportunity, and you ask, well, what about this regulatory risk? Or what about, this adverse impact on consumers or on the climate that, by the way, can, translate into regulatory action? They're kind of like deer in the headlight. Then you have your answer, right? So we try to make sure, if we're invested in those types of strategies, that they are integrating that risk mitigation angle of what FCI does. But I think the other aspect of this that's very important is time horizon, right? A lot of these large social or environmental challenges, think about climate change, the mechanism of that getting priced into, let's say, security prices is long-term, because these are long-term challenges. And if you're, let's say, a private equity investor who's investing for the next 10, 15 years, there's alignment in terms of your time horizon and the time horizon through which these challenges and these risks show themselves and get priced. But if you're a hedge fund manager, for example, doing credit or, distress arbitrage or shorter term, where your average hold period for a given security or a given investment is 6 to 9 months, the 2-degree world doesn't come into your horizon for the next 6 to 9 months. So maybe it's not as important that you're looking at transition pathways when you're investing into an arbitrage opportunity. And that's okay, right? And there's a role for that type of strategy in every portfolio, or not in every portfolio, but in many portfolios. And the bar might be a little bit different for things that have inherently shorter time horizons. But for most of what we do, we have a strong bias towards fundamental long-term type investors and investment strategies. And for most of that, these large social and environmental challenges are material to pricing over the long term.
How do you think about team and track record? And I ask because, I used to sell data storage infrastructure, software and hardware many moons ago. And there was a joke that no one ever got fired for, for buying IBM, right? At the same time, an upstart could come along with a better product, like one that is smaller, is faster, is more reliable, is cheaper, is more modular, is easier to scale, more flexible, whatever. But it's not from IBM. It's how do we know this company's even going to still be around in 5 years? And so if we base our whole infrastructure on it or a meaningful part of it, there's big risk. So how do you think about that as it relates to funds? The equivalent, I guess, would be no one's ever gotten fired for buying Sequoia Fund 82. What does that mean from an emerging manager standpoint that maybe has some novel ideas but not as much of a track record, at least working on that strategy with that team?
I think I mentioned earlier that sort of our process and approach starts with the belief that we don't have to be anywhere and do anything. And we bring that to our work on emerging managers, right? I would say, when, as it relates to climate-related investments, for example, we recognize that that's an opportunity set that we have some level of conviction around. And there are few teams that have existing long track records. If you really filtered the universe of folks that could tackle the climate opportunity set by folks that have had, 10 years of track record, you would end up with a handful of names, right? A handful of teams. And by the way, half of them might have terrible track records because they got caught up in climate tech 1.0 earlier on. And that, raises more flags than it helps build conviction. And so, we recognize there are, as I mentioned earlier, there are really interesting groups of investors coming together around this theme to take advantage of this opportunity set. And then evidence of that is we have a lot of generalist managers, let's say in venture and private equity and public equities, that are now identifying decarbonization as a core theme for their theses going forward over the next few years, right? These aren't climate experts. They just know that this is a compelling opportunity set. And so, we have on the margin higher tolerance for new teams coming together, maybe without shared track records around this theme. But we look at emerging teams sort of in the same way across all of our asset classes and across all of our strategies. And so, it's different when it's I was an investor at this other fund that maybe Hall Capital was already partnered with, and I'm spinning out to do something climate focused because that was part of what we were doing at a generalist fund before. And now I want to dedicate a whole strategy to it and build a team. We are two different teams from two different funds that each have a track record, but we're coming together to build a dedicated strategy here. And that helps us sort of kick the tires on, again, what is the proof of success for this team executing on this opportunity set? And often, and this is maybe back to our size, it might not make sense for us to back the first-time team around a given theme. One, because we don't have to be anywhere. Two, because that might not be scalable for a scale of capital. And three, because, we don't think this opportunity set is going away. And that's part of why it's compelling, right? If I thought that the climate...
Compelling and scary as hell, but yes.
Absolutely. But if I thought that the window of investing around decarbonization is closing by Q3 this year, then we should probably not invest in it at all, right? And because I think the opportunity set is available and sustainable over a longer period of time, we can afford to wait until there is a little bit more evidence of success for a given team sometimes. That's not to say that we don't get over that threshold ever. We've done several things with first-time teams. We've anchored funds around this sort of climate theme especially over the last couple of years. But those, have been groups where we have had other ways of evaluating, again, the proof of success. I want to go back to the last thing you asked on the concessionary piece, unless...
Oh, yeah, exactly. Yeah, we didn't hit that. That'd be great. Thank you. Good catch.
So I'm very focused on concessionary impact investments, not, doing harm out there in the market by providing low costs of capital funding to an ecosystem that then, sort of gets rid of sustainably funded, normal cost of capital, other businesses that compete with it. And then if this low cost of capital isn't sustained, you end up with an outcome that is worse than where you started. And a clear example of that is, this is not in the climate space, but in microfinance across emerging economies, you saw some of this, right? You saw a lot of low cost capital.
For whatever reason, I went to VCs subsidizing ride sharing. It's not an impact analogy, but it's
not dissimilar.
Yeah.
But let me stick to the microfinance because I, don't want to make my friends upset. But in microfinance, you had a, low cost of capital lending happening in communities where maybe there was one bank that wasn't very active in lending, and the competition was really sort of predatory otherwise. And you flooded that market with low-cost concessionary capital, and the bank packed up and left. And any other available form of financing also packed up and left because they couldn't compete, right? And there was a downturn in the economy or whatever, the LPs dried up, and there's, surprise, no more microfinance money coming into that community. And now you've ended up with a community that has no access to financing rather than just, bad access to financing or access to maybe predatory financing. And so we've been focused on this. So where we've landed is we would do things, and we have done things that we would describe as impact first. But we don't do those things if we think it's just the same investment strategy as another with a lower cost of capital, right? We would only do it if there's some other trade-off. For example, this is a nascent market where it's really hard to establish what the right expected risk-adjusted return should be, right? Could be in, we did a set of transactions around climate that were focused on preventing forest fires in California. It was a really creative structured credit strategy, and it was really, no one's done it before. So it was really hard to figure out what the right expected risk return is. Or, we've done a strategy where it's a mix of project finance and private equity and some other, bells and whistles in that strategy. And again, no one had done it in this way, and it was hard to figure out what the right risk-adjusted return expectations should be. So we might, do that as an impact first, probably for clients that have an explicit focus on climate themes. That wouldn't go into all of our portfolios. Or most prevalently, there's a trade-off in terms of liquidity. So maybe you're not getting paid for your liquidity trade-off. Maybe you're not sure what this market should look like. And sometimes it's also, there's a team that's experimenting with interesting ways of compensating themselves. So for example, we made an investment where the team was getting compensated their carry entirely based on an impact, meeting a set of impact metrics, right? So there was no financial incentive for the team. It was purely based on whether they can, reduce emissions by a certain amount through their investments. And so that's interesting. We wanted to support that. We don't think that strategy is concessionary out there in the market. They're not giving money away at a lower cost than other players in the market. But we also, as I mentioned earlier, are really focused on organizations and what makes organizations tick and what drives people and how they're compensated. And this is one where they're not incentivized in the same way as other, let's say, private equity investors in terms of driving financial returns. So we categorize that as an impact first opportunity. And we, put that in portfolios that, again, had an explicit focus, but wanted to be supportive of that experimentation with compensation structures.
Well, there's so many topics we haven't covered yet. There's no way we're going to get to all of them. There are a couple I want to make sure we hit before I let you go. One is in terms of what you're seeing out there in the market. So we're recording in early April of 2023. How much has the denominator effect factored in with your clients as it relates to their alternative asset investments generally? And then same question for alternative asset investments with more of an impact focus.
So that's definitely a real dynamic. Maybe your audience might not be as familiar with how this works, but if you have a portfolio that comprises of liquid strategies and illiquid strategies, your liquid investments have gotten marked down on a daily basis over the course of the last year. Your illiquid investments, let's say your venture capital, your private equity, your private real estate, haven't gotten marked down because typically in those strategies, the valuations are marked based on subsequent transactions. So let's say you are a VC investor, you invested in a startup at some valuation. You don't really change that mark typically unless you have other reason to believe it's now valued less or more. Usually it's geared based off of a subsequent round that startup has raised, which may be a down round or an up round. And we know that the pace of fundraising and the pace of those transactions in private markets have slowed materially over the last year. And so there haven't been a lot of those subsequent transactions. So what you see, if you're, again, an asset owner with that portfolio of liquids and illiquids, is that if you had an allocation that you thought was X% to illiquid investments and Y% to liquids, you now have an outsized allocation to illiquids just because of that dynamic. So out the gate, committing an incremental dollar to an illiquid investment today probably faces more obstacles than it did a couple of years ago. We observe that and we act based on that, and we don't let that get in the way of us staying the course with our private investment sort of program. The beauty of investing in private equity or venture, for example, is that you invest vintage after vintage and you kind of look at it as a program, not individual investments. And putting this denominator effect aside, when you look at the environment today in the markets, you might look at it and say, actually, this is maybe quite an attractive opportunity set for, say, a VC investor or for a private equity investor or a real estate investor. And so we want to make sure we're committing capital and deploying capital through this environment. On the margin, it might be a question of sizing and a question of the number of relationships. So it's a balance between, not wanting to allocate a lot more illiquid dollars in a portfolio that is already, facing liquidity challenges, and making sure that we're still deploying capital through what could be a pretty attractive vintage for private investments.
My last question is more around philanthropic capital and how much you get involved with advising clients, if at all, in what to do with their philanthropic dollars, especially because, I learned recently, and we've taken advantage of a bit, the fact that you can use things like donor advised funds or, philanthropic capital to do private investing, whether it be in funds or in companies directly. And I wasn't aware of that. I feel like a lot of people that have this philanthropic capital aren't aware of that. And and I'm just curious how active you are in that area and how much you think about that, if at all.
So, we manage a lot of investment portfolios for endowments and many foundations or family foundations. Most of our clients have very active sort of philanthropic efforts on their own. We don't really advise on the grant-making part of giving. We work with partners and we introduce our clients to partners who can devise some more thoughtful strategies around that. That's not a core capability that we have. We share our thoughts, and again, we tend to have comprehensive relationships with our clients. But where we probably add the most value there, for example, is how much can you afford to give, and what would that path look like over the next X number of years? On your question about sort of, I would view the second part of the question on the donor advised funds as sort of a question around the sources of capital for impact investments. And that's actually something that I and my team are actively exploring now, because we have to manage a lot of, again, philanthropic pools that have really compelling giving strategies on the grant making side, but might not be invested fully aligned with the giving strategy and the giving goals. And so we want to make sure that we have a way to do that and integrate that and respond to that need. We also manage assets for community foundations, which might have donor advised funds underneath, and might want to offer those underlying donors ways to put their investment capital to work that's aligned with what their giving goals are. And so that's a lot of the work that's done in terms of, back to FCI, like that overlap of where you have environmental, social impact as well as financial returns, but also part of what we were talking about under our version of Impact First, where you might take certain trade-offs for, if you really care about a given set of outcomes, you might on the margin, have higher tolerance for liquidity or nascency of markets, et cetera. But that's an open question. I think there's also some sort of bills in Congress around, dictating what donor advised funds may or may not be able to do. And so that's an area that we're watching closely. But on the grant side or grant making side, we don't actively advise our clients.
Ideally, it would be a benefit to the world and to asset owners, presumably, to get more capital allocated in a full consequence way. What are the barriers that you see to more of that occurring? And if you could change anything that could unlock faster progress in that area that's maybe outside of the scope of your control, what would you change and how would you change it?
The reason I'm doing what I'm doing, and the reason I came back to Hull Capital to do this work, was because when you look at long-term social and planetary challenges, and you look at the scale and magnitude of that, and you think through the type of capital that could really tackle those challenges, that doesn't care about returns this quarter, next 2 years, it's really not a lot of pools of capital, right? And when you look at the client base of Hull Capital, it's, again, families with multi-generational investment horizons, endowments with perpetual investment horizons that are really well set up to take advantage of opportunities that come out of those challenges. And that's what makes me excited. And I think a barrier to that is more, the onus is on me and the onus is on you, Jason, to prove that you could do this. You could have impact, you could tackle those challenges and generate return and, achieve the financial goals that these groups and this type of capital has. And so that's a little bit my life's work. If I had my drudges and could get rid of something in the world, would be this sort of quarter over quarter short-termism, which really prevents us looking beyond. You saw some of that last year. Oh, energy, traditional energy ripped. And so therefore, investing in renewables is a bad idea. Well, let's think through, the next 2 decades. Let's think through 2050. If you're looking back at 2050, where would you like to be? Which side of this transition would you like to invest behind? That becomes more clear. So having that long-term horizon, which I think Hull Capital is pretty well set up to have our clients, having that become more prevalent throughout the marketplace would really make a difference.
I love that. And the answer to this last question might be nobody, Jason, please leave me alone. But for anyone out there listening who's inspired by the work that you're doing, is there anyone that it would be helpful for you to hear from, or is there anything that we can do, as MCJ or as MCJers that are tuning in, that could assist the work that you're doing and the work that you want to see done more broadly?
I learned so much from your podcast, and a lot of it is operators doing the actual groundwork of this climate transition or energy transition and decarbonization. I'm really excited about this sort of series that you're exploring, talking to investors, both GPs and LPs, and that's helpful. That's more helpful for me to hear and learn about what other groups that are tackling this from an investment lens doing and how they're thinking about it. I think one area that may be on your radar may not be on your radar, and I think maybe it, might become relevant in a few months as there's more developments there, is I would love to hear more from people who are on the ground doing the legwork of some of these big regulatory changes, right? So we have the IRA, everyone's excited about it. A lot of the devil is in the detail, and a lot of that guidance is expected to come out shortly. It would be a podcast episode I would really look forward to have someone really walk us through all, some of the different incentives that are captured in that, and how that, what the mechanism of that is in terms of flowing through to businesses and their unit economics. Because that's relevant for, your broader community that are doing, again, the groundwork from an operation perspective, but also really relevant to GPs who are building investment theses around these themes and regulatory incentives. And it's also really relevant to me to be able to understand that landscape.
That's a great idea. We should definitely do that. And last question, Mohammad, is just anything I didn't ask that I should have, or do you have any parting words for listeners?
No, you asked quite a few things. This has been a really great conversation for me. And actually, I was, when we got disconnected for a bit, I was thinking, wow, if I, when I go back to work after this, I'm going to be so much more energized now, having sort of explained it out loud. So thank you for that.
I feel the same. And I think, I don't want to overpromise, but I think you're going to inspire a lot of people with this episode as well. Both the mindset that you have as a firm, which is refreshing, but also your willingness to share it more openly, which so many aren't. So thanks for being brave and being an early adopter on this new series, and thanks for the work that you do as well. It's inspiring, truly.
Thank you for the work that you do. I've learned a lot from your work. Thank you, Jason.